Hey there, fellow traders. Welcome back to another exciting session where we dive deep into the world of trading strategies. Today, let's talk about a strategy that's near and dear to my heart: top-down analysis. This approach is a game changer for anyone serious about making informed trading decisions. Think of top-down analysis as having a detailed roadmap for the market. It guides you to the best trading opportunities by starting with the big picture and then zooming in on the details. Instead of getting lost in the weeds with individual stocks, we start by looking at the big picture. This means analyzing the overall market trends and understanding the broader economic environment. Think of it like this. Imagine you're building a house. You wouldn't start with the bathroom tiles, right? That would be chaotic and inefficient. You'd start with the foundation and the overall structure. The same principle applies to trading. That's what top-down analysis is all about. We begin by assessing the overall market direction. We start by asking ourselves, is the market in a bullish phase, a bearish phase, or is it moving sideways? Understanding this helps us align our strategies accordingly. Is it a bull market, a bear market, or somewhere in between? Each of these market conditions requires a different approach. Once we have a sense of the broader market, we can zoom in on specific sectors that are poised for growth. This step is crucial because not all sectors perform equally well in different market conditions. Finally, we zero in on the most promising individual stocks within those sectors. This is where we get into the nitty-gritty details, analyzing company fundamentals, earnings reports, and other key metrics. It's like using a telescope. We start wide and gradually narrow our focus, ensuring that we don't miss any critical information along the way. We start wide and gradually narrow our focus. This methodical approach helps us make well-informed decisions. Top-down analysis is all about having a systematic approach to trading. It allows us to be strategic rather than reactive, which is essential for long-term success. It helps you make informed decisions based on solid research and analysis. This way, you're not just guessing or going with your gut feeling. So buckle up and let's dive into the exciting world of top-down analysis. This journey will equip you with the tools and knowledge to navigate the markets with confidence and precision. All right, let's talk about how to read the market like a pro. Understanding the market is crucial for making informed investment decisions. Whether you're a seasoned trader or a beginner, knowing how to interpret market signals can make a significant difference in your trading success. The first step in our top-down approach is to analyze the overall market trend. This involves looking at the big picture to understand the general direction in which the market is moving. By doing this, we can make more informed decisions about individual stocks. We want to know if the market is heading up, down, or sideways. Identifying these trends helps us align our strategies with the market's momentum. For instance, in a bullish market, we might focus on buying stocks, while in a bearish market, we might look at short-selling opportunities. To do this, we look at major market indices like the S&P 500, which represents the performance of 500 large companies listed on stock exchanges in the United States. It's a great indicator of the overall health of the market. The Dow Jones Industrial Average, which tracks 30 significant publicly owned companies, and the Nasdaq Composite, which includes more than 3,000 stocks, primarily in the technology sector. These indices provide a snapshot of market performance across different sectors. These indices are like the pulse of the market. They tell us the general direction of stock prices. By monitoring these indices, we can gauge investor sentiment and market conditions, which are crucial for making strategic investment decisions. We also want to keep an eye on key economic indicators like GDP growth, inflation, and interest rates. These indicators provide insights into the broader economic environment, which can influence market trends and investor behavior. These indicators give us clues about the health of the economy, which directly impacts the stock market. For example, strong GDP growth typically signals a healthy economy, which can boost investor confidence and drive stock prices up. Remember, the market is driven by supply and demand. When there are more buyers than sellers, prices go up. Conversely, when there are more sellers than buyers, prices go down. Understanding this basic principle is key to navigating the stock market. When the economy is strong, businesses are booming and investors are confident. Demand for stocks goes up, pushing prices higher. This is often referred to as a bullish market. where optimism prevails and stock prices rise. On the other hand, when the economy weakens, demand for stocks falls and prices tend to drop. This is known as a bearish market, characterized by pessimism and declining stock prices. By understanding these dynamics, you can better navigate the ups and downs of the market. Once we have a sense of the overall market direction, it's crucial to delve deeper and identify the areas that are showing the most promise. This involves a more granular analysis of the market, breaking it down into various sectors. It's time to zoom in on specific sectors. By focusing on sectors, we can better understand which parts of the market are thriving and which are lagging behind. Sectors are groups of companies that are in the same industry, like technology, healthcare, or energy. Each sector has its own unique characteristics and can be influenced by different factors. Not all sectors perform equally well in all market conditions. Some sectors may thrive during economic expansions, while others may be more resilient during downturns. For example, in a booming economy, cyclical sectors like consumer discretionary and industrials tend to outperform. These sectors benefit from increased consumer spending and business investments. On the other hand, in a recession, defensive sectors like consumer staples and healthcare tend to hold up better. These sectors provide essential goods and services that people need, regardless of economic conditions. Our goal is to identify sectors that are outperforming the broader market and showing relative strength. By doing so, we can position ourselves to take advantage of these trends. We can do this by comparing sector performance to the overall market and looking for sectors that are making new highs or holding up better during market pullbacks. This comparative analysis helps us pinpoint where the strength lies. There are various tools and resources available to analyze sector performance. These tools can provide valuable insights and help us make more informed decisions. Financial websites and platforms often have dedicated sections for sector analysis, providing charts, news, and data. These resources can be incredibly useful for staying up to date with sector trends. By identifying strong sectors, we increase our chances of finding winning stocks. Focusing on sectors that are performing well can lead us to companies that are likely to continue their upward trajectory, providing us with better investment opportunities. Now comes the exciting part, picking individual stocks. But remember, we're not just throwing darts at a board, we're using our top-down analysis to guide our decisions. We've identified the overall market trend and the strongest sectors. Now, we're looking for the best companies within those sectors. This is where fundamental analysis comes in. We want to look for companies with strong financials, solid management teams, and a competitive edge in their industry. We're talking about things like earnings growth, revenue growth, debt levels, and return on equity. These are all clues about a company's financial health and its potential for future growth. But hey, we're not just number crunchers. We also want to see how the market is reacting to the company's story. That's where technical analysis comes in. We're looking at charts, patterns, and indicators to assess the stock's price movement, trends, and potential entry and exit points. Section 5, Risk Management, Protecting Your Capital. Listen up, traders. This is crucial. Risk management is not optional. It's the foundation of long-term trading success. Before you even think about clicking the buy button, you need a plan to protect your hard-earned capital. The market is a wild beast, and it can turn against you in an instant. That's why we use tools like stop-loss orders. These are orders that automatically sell your stock if it drops to a certain price, limiting your potential losses. Think of it like an insurance policy for your trades. Position sizing is another critical aspect of risk management. This is about determining how much of your capital to risk on any single trade. Remember, diversification is key. Don't put all your eggs in one basket. By spreading your risk across different stocks, sectors, and asset classes, you're protecting yourself from a single event wiping out your entire portfolio. Section 6, Stay Agile, Monitoring and Adjusting. Congratulations. You've entered a trade using your top-down analysis, but the work doesn't stop there. The market is constantly evolving, and you need to stay informed and be prepared to adjust your trades as new information emerges. This means regularly monitoring your positions, tracking your portfolio's performance, and staying up to date on relevant news and events. Remember, your initial analysis, no matter how thorough, is based on a snapshot of the market at a specific point in time. Things change, and you need to be ready to adapt. This might involve adjusting your stop-loss orders, taking profits, or even exiting a trade altogether if the original thesis no longer holds true. Section 7, Top-Down Triumph, putting it all together. So there you have it, top-down analysis in a nutshell. By starting with the big picture and gradually narrowing our focus, we can identify the most promising trading opportunities. Remember, this approach is not about predicting the future. It's about making informed decisions based on solid research, analysis, and risk management. Here are some best practices to keep in mind. Stay disciplined. Stick to your trading plan and avoid making impulsive decisions based on emotions or market noise. Do your homework. Thoroughly research and analyze potential trades before investing your hard-earned money. Manage your risk. Protect your capital with stop-loss orders, position sizing, and diversification. Stay informed. Keep up to date on market trends, news, and events that could impact your trades. Be patient. Successful trading takes time, discipline, and a long-term perspective. Section 8. Never stop learning. The market's always changing. The world of trading is constantly evolving. New technologies, changing market dynamics, and unforeseen events can all impact your trading success. That's why continuous learning is not just beneficial, it's essential for staying ahead of the curve. Seek out knowledge from reputable sources, attend webinars, read books, and consider taking courses to expand your trading skills. Network with other traders, join online communities, and engage in discussions to gain different perspectives and insights. Remember, trading is a journey, not a destination. There's always something new to learn, and the more you know, the better equipped you'll be to navigate the exciting world of trading.